Liquidity refers to how liquid a market is. And what I mean by that is how readily available are buy or sells in a market. Okay. So the Forex market is the most liquid market in the world. That means there are always active buying and selling market participants on either side of the trade, except for super exclusive incidents like market crashes, absolute economic crashes, which really don't happen very often. So generally, we are always fine with our liquidity, and we are always ready with someone on the other side of our trade to execute. So that means if we are selling a market, there's always someone on the other side to buy from us. If we are buying a market, there's always someone on the other side of the market to sell to us. And yeah, that is what liquidity is. So we are retail traders, and our orders are not that big now. Even the retail traders who are trading, maybe millions, just a couple million or something in orders, their orders are essentially going to be able to be activated quite easily. But the liquidity problems come in with the institutional players, with the banks, the hedge funds, the larger financial trading firms. Now, these guys are trading some serious cash. They're trading hundreds of millions, billions, right? And when they do that, there's not always someone readily available on the other side of their trade to fulfill their order. So that means if they want to, for example, sell $1 billion worth of GBP JPY, there's not going to be a retail trader on the other side with $1 billion ready to activate their order, ready to, exchange with them, so to speak. So what that actually does is cause liquidity issues where the market then has to go and seek the orders to activate so that they can actually pile on the large volume of orders that they're looking for. So what I've got here is a great example on GBP JPY, which I'm going to talk through with you and show you exactly what I'm talking about. So the best way to identify liquidity is to identify equal highs or equal lows in the market. I'm going to drop to the hourly chart and I'll show you the GBP JPY market here and try and explain what I mean with this liquidity. So we know retail traders are generally not looking at the key levels, the zeros, the 250s, the 500s, the 750s that we've spoken about, okay? Retail traders are finding their support and resistance levels simply on areas where the market has bounced numerous times. So for example, if we look at this area in the market, we can see here 1, 2, 3 equal highs. So that's one area where people are selling, 2 area where people are selling, 3 area where people are selling. So most traders, retail traders will see, okay, resistance, we want to sell from resistance, buy from support. That's the general education, the general thing that everyone tries to do. And that is exactly how the liquidity is then fulfilled by these larger institutions, right? We know we have sellers here, and sellers here. So think about it. Where are their stop losses? Their stop losses, most people are taught over the previous high. So the stop losses in this example for these guys is going to be up here. And this is generally that liquidity that we refer to, right? We have an area in the market where orders are sitting. We have sell orders here, we have stop losses here. So if these dudes, the hedge funds, etc., want to get $1 billion worth of GBP JPY sold, they don't have anyone actively available right here to sell or exchange that $1 billion worth of GBP JPY with them. What these guys need is to then go and fish for the liquidity, which means they have to find orders in the market. So we've got sellers, and a hedge fund who is looking to sell. So let's say we are them. Now, we can't actually get all of our order in here. The market, it will not allow it. There is just not enough volume on the other side of our trade to get us in. So what we actually have to then do is fish for the liquidity, which means activating other orders. Now, if we had a way to actually trade into this level and activate the liquidity in this level by stopping all of these guys out, that's actually then going to provide the liquidity, provide those orders that can then be liquidated into the hedge fund position to then sell the market off, right? Does that make sense? So what we actually need to do is achieve these other orders, tap into them. That's going to provide a massive liquidity as all of the sellers at these 3 equal highs here are taken out, and all of that liquidity can then be pumped into the short position for the institution. So this is why so many traders get caught out time and time again, because they're focusing on these wishy-washy retail resistance points, right? They're not using these key levels. They're not using supply and demand. They're simply focusing on a level that prices bounced off a few times. And that is exactly what this is. So what we would really expect to see here is for price to push through resistance, right? Trade higher to fulfill this liquidity and then sell off. Now, if we use what we've learned, we'll actually see that we have here a supply zone, right? Big uninterrupted movement with a consolidation zone before it. So this is a supply zone. And what did we say about supply zones? It's an area that the institutional players are looking to sell their orders from. Now, if we also want to activate a key level, which we always do, we want to focus on key levels only, not the silly resistance or support points that we draw on ourselves. We want to focus on the 250s, the 500s, the 750s, and the 0 levels. We can see that we have a key level right in the center of this supply zone. And what this actually does is sit right above the 1, 2, 3 equal highs that we have here in this GBP JPY market. So we know beneath this point, which would be our target entry point, which is attempting to trade in line with the institutions. And between the retail sellers entry point, we have a bunch of orders. Now we've got the stop losses from the 1, 2, 3 equal high sellers. And we've also got, well, we will have, when we trade through this level, long traders who want to buy the market, right? They see, okay, we have 1, 2, 3 highs. They've been taken out. If we see closure above this level, we can then buy the market into an uptrend. Okay. So we've got sellers and buyers with orders in this area. Now, what that's actually going to do then is push the market through to fulfill the liquidity, to get the size of the order that they're looking for, take out the sellers, activate the buyers into the market, and then catch the buyers out as well. So we can see the market reacts very nicely out of the supply zone, off the key level, and comes all the way back down, taking out all of the buyers that brought in on the breakout. So there you can see a great example of liquidity. Okay. We have 1, 2, 3, and now 4 equal highs. That shows that selling pressure is at this level. But really, we've got such importance over this level because we have these other guys who want to sell, the large players who want to sell, who need to fulfill more liquidity. They need to trigger orders to get their order in. So they're looking at key levels, supply and demand zones, and identifying where all the other traders have got their stop losses. It's actually easy to think where most traders are placing their stop losses because everyone is educated in the same way. They see, equal highs. They see a resistance working. So what do? You sell the resistance with a stop over the high. So we know that, right? We know that that's going to happen time and time again. Now, when we see equal highs, we know that price is probably going to go trade over them. Okay. So there we go. That would have avoided a loss there. Hopefully that's just opened your eyes a little bit to if you were getting caught out because you were one of the guys that sells here and you're thinking, damn, why does the price always take me out before reversing? Well, now you know. It's because the larger players in the market need to fulfill their orders by wiping out yours. And that is essentially liquidity. The market will then proceed to come down, and should we trade in line with it, which we will do, and if you remember everything I've taught you so far, the supply zone, the key level, if we were using that, we would have traded in line perfectly with this institution. And rather than selling from this pointless resistance point and losing, we would have sold in line with the big players and be sitting in some serious profit now. So there you go. That's liquidity in a nutshell. And it's best identified by finding equal highs and equal lows in the market. We're essentially looking for areas where the masses will be buying or selling. Now, I'm going to show you another example from the flip side of it on the buy side. Now, this is an example that I took with my private trading community, and it was a really, really nice trade, and it really highlighted the importance of identifying liquidity and the accuracy of using everything I've taught you so far rather than using the normal retail techniques. So here we have GBP JPY 4-hour chart. We're in an uptrend, right? Higher highs, higher lows consistently. Very nice to see. We know we want to buy this market. Now, what we've got is a support point here where we have this 1 equal low, 2 equal lows in the market. So this acted as a support, and we saw people buying from this level. Now, I know for a fact that people were buying from this level because I'm very active on social media and I saw so many people buying here. And, I just felt sorry for the outcome they were going to get because I already could see through this and I knew what I was looking for. So what do we have here? Not a key level, right? The 138.60 level, that's not a key level. We also don't have a MET demand zone over here. The demand zone in this instance is right here, this consolidation at the bottom of the movement. So what we actually want to focus on, rather than wishy-washy support points and resistance points, we want to focus on supply and demand, key levels, and market structure. Okay, so we want to see a higher low form in the market, right? Higher low than this one, but we do need to see first a demand zone and a key level met. We don't just want to go buying just because the price bounced. So whereas people were buying there, we can understand the liquidity that we've used, and understand our demand zones that we've spoken about and our key levels, and we can actually see then, right, we have the 138.250 key level, we have a demand zone, and we've got here this kind of pointless support. And we can see that retail buyers are buying in here. Where are their stop losses? Underneath the lows, okay? So these guys think the market's going to keep going, but they've brought in from essentially quite a stupid point. So this is the trade that I went in with my team. We brought from that key level, stop beneath the low, targeting over now these 1, 2, 3 kind of equal highs. So we know there's now liquidity over this level, right? Because we've got 1, 2, 3, mainly these two equal high points in the market with sellers above. So there's now liquidity either side of the range. We know that the stop losses are waiting down here, and we know that an institutional player is going to push the market beneath to wipe out these orders so that they can accumulate their massive orders by using this liquidity. So if we watch this now, we'll see the market comes down, precisely triggers off of that key level, out of that demand zone. All of the sellers from this market are taken out. I actually shared a post on Instagram with the market like this, and I said, buy or sell. The amount of people that said sell, it made me a little bit sad because, you can see why, right? Low point, low point. What it looks like here is basically a break of this support and a retest, and it looks like the market's going to come down. But that's not the case. And if you understand what I'm teaching you in this course, which you should begin to grasp by now, you'll see that that's not the case, is it, right? What we're actually looking at here is an area where the real buy point has finally been triggered, and these large players have activated their orders. So we saw a absolutely to the pip precise tap off that key level, and then the market began to move to the upside. And what it did then was take out the previous equal highs and bomb through the sky. And that is exactly how we want to trade, okay? Rather than getting caught up in the liquidity and being the people that provide the liquidity for the big boys in the market, we want to be on their side. We want to be trading with them. So essentially, we are entering where everyone else is getting stopped out. Does that make sense? So I hope this has opened your eyes. If you didn't understand liquidity before and you were struggling in the market by losing and losing and losing because you were following these general retail methods, then hopefully now you're beginning to understand how to avoid that and why you were actually losing. It's because you and your money was providing the liquidity needed for the big players in the market to activate theirs. Okay, it's sad, but it doesn't need to be like that anymore because you're getting the right education and you're being pointed in the right direction. So I hope that this video has been very useful. Now, key pointers. Most people are getting chewed up and used as liquidity. To identify liquidity, we are looking for equal lows and equal highs in the market that don't really have much validity. For example, this point here. Okay, yeah, we've bounced twice, but why? Is there a key level, a 0.50, 0.750, 0, or 250 level? No. Is there beneath? Yes. Is there a demand zone? No. But is there beneath? Yes. So, in line with the demand zone, in line with the key levels, and in line with, of course, the higher high, higher low structure of the market, we will then actually look, right, where do we think these guys have got their stop losses? Well, beneath the low. So we've seen 1, 2 bounce, buyers, stop losses, push through, take these guys out. These guys are crying. We're just entering the trade, getting the best possible entry, and bam, off we go. And we get the biggest move because when the liquidity is fulfilled down here, that is actually then big institutional orders flowing into the market rather than retail orders. So when we see a move like this, this is off the back of essentially a bank or a hedge fund or someone with billions or hundreds of millions of dollars of trading capital being injected into the market. So if we're trading on the right side of these guys, we are going to be on the right side of momentum. So I hope that that has opened your eyes to a new way of viewing the markets. Now, liquidity is going to be a difficult one to identify. And if it's just new to you now, it's probably a bit mind-blowing, and it's probably something you're going to see, damn, I've been losing to this liquidity for some time. I've been providing the liquidity for the big players in the market when really I should have been trading in line with it. But that's completely fine. You are learning here a pretty amazing strategy that I've found my success with, and I believe that you definitely will too. So the idea of liquidity then, my key pointers, a bit of homework for you now before we move into the next video. Go into the markets, identify these areas where we have equal highs and equal lows, and also then find out, is the equal high, is the equal low a nice valid level? And if it is, cool. Maybe it is a good sell point. If it's not, though, and we do have multiple equal highs or equal lows, well, then think about it, right? Where are the stops going to be above that level? Okay, they're going to be sitting just above it or just below it if you're on the other side of the market. And price is likely to go trade into there before the next orders are accumulated. So, final example, GBP USD, 4-hour chart. I'm going to show you something quite interesting here. This one, we have 1, 2, 3 equal highs. Okay, the first point, right, was the supply zone. So when we saw this, we could sell from there. Okay, supply zone, retest, sell. But now that we've actually seen the market come back into this level for the second time and tap into it, well, then there's sellers here, there's sellers here, and there's sellers here. And these two are essentially completely equal lows, equal highs, sorry. So we know there's sellers there, we know there's sellers there, and we know there's sellers there. So where are their stop losses located? Well, the sellers here have their stop losses over the high, and the sellers at these ones have got their stop losses there. So this whole area is a big area of liquidity. Now, this is not to say the market isn't going to go down. The market could very well go down. But before it goes down, it's going to need to go down with the pressure of the big institutional players. So they need to go and fulfill their orders. Now, this was a great trap that I recently saw, and I profited off it, and my team profited off it, while everyone else was getting burned. And the reason was because we understood the prospect of liquidity. Now, if we actually view this market, what we're going to see is the liquidity above these levels taken out. So the sellers here, and the sellers here have now been burned. Their stop losses are triggered. They've lost money. That money that they've just lost has flowed into the market, into the hands of the sellers to fulfill the liquidity of the institutional sellers who are now going to look to drive the market down. So we've got sellers above this level which have been burned. And now what we also have is a closure. Okay. And if you've done some education before, you're probably familiar with breakout trades, right? So we've got resistance, broken. So now we can actually look to buy the market and take it higher. I also saw a lot of people doing that. So we got buyers now thinking, yep, let's dive into the market. Stop loss beneath there and we'll be just fine. We can get an amazing trade now. Yep, we got burned this time, but we can actually get in on the right side of it now. And what really happens is these guys get burned as well. Because what was actually happening is the reason that this level was taken was to liquidate the orders, to provide the selling pressure that these big boys needed to get into the market. So we saw a huge sell-off from there, of which we can capitalize on now that we understand liquidity. And bam, once again, another great sell-off to profit from. So there we go. That is liquidity in a nutshell. We are essentially identifying where stop losses are for the majority of market participants and looking to enter where those stop losses are. Okay, we want to focus on our key levels, our supply and demand zones, and do not fall for these equal highs. If we get equal highs in the market or we get equal lows in the market, chances are we are going to run through them. Now, I would say here, we do have a bunch of equal lows, kind of 1, 2, 3, all around this area. Now, I will expect to see liquidity push through this point at some point because we have buyers, right? So I would expect, even if we do go run the liquidity over this, at some point we are going to come through and take these buyers out before continuing up. So hopefully this video has been useful. Hopefully it's an eye-opener. Go away now and try and identify stop losses for most market participants. See if you can find out the areas where orders are likely to be liquidated to actually fulfill the trades that the huge market players are looking for. So thanks for watching. I'll see you in the next video when we're going to talk about momentum and market momentum, which is going to be a very useful follow-on from this liquidity video. So I hope you've enjoyed. Make sure to do a bit of back testing, a bit of homework on the charts. Use the past price data as I just have to try and identify these liquidity points, equal highs, equal lows in the market, and see, are they valid or are they going to be taken out? Okay. The best way to learn is to simply go and view things for yourself. So thanks for watching and I'll see you in the next video.